Okay, here we are. It's Tuesday morning, November 21st. Good morning, everybody. It's time for our weekly webinar. It's a big week this week. It's Thanksgiving week, so I hope you have some really great plans. I hope you're going to have some good time with family and some good food, maybe, and remember all the things we're thankful for. And I'll just start with, I'm thankful for you all, and I'm thankful for my staff and all my clients and, of course, my family, but I really appreciate the opportunity to come to you every week and have this discussion via YouTube. It's been a lot of fun as we build out this platform and see more and more people subscribing to the channel and talking about the videos. And almost every one of you that comes in, certainly new clients come in, after watching many videos, and it's helpful for you to learn these things. And it's not only initially, but on an ongoing basis. So that's why I do this. So that if you're an existing client, you can join us every Tuesday or listen when we send you the recordings or watch when we send you the recordings and stay up to date with things that are going on and remind yourself why you're doing these things like the tax efficient planning. We're finishing up Roth conversions. We're really, really close. I got to give a lot of credit to my team again, Emily and Hamiko and Jess, of course, and Delisha, our new member, Delisha, for taking care of our clients so well and getting these things done. And we're just about there. We've got another couple weeks to push through, maybe 3 weeks to push through and get these done. But we've got some clients graduating this year where they're all done their Roth conversions. They're all done their tax efficient planning, and they're on their road to tax efficiency or zero tax in retirement. And boy, is that exciting. But so thankful for all those things. And I was saying that clients, it's a good opportunity for you to listen to these webinars and the future podcasts and remind yourself what we're doing here at Attleboro Wealth Management for you and why you do these things like Roth conversions and tax efficient planning. And for new people, if you're new to this, it gives you an opportunity to learn who we are. Spend a couple hours with us or some time with us, before you schedule an appointment or before you, talk to us about potentially becoming a client. And, unfortunately, we can't take everybody, but we seek out those folks that we can really have an impact on and, are a good fit for our group. And we really, really dig deep into our clients' financial plan. And we're going to talk a bit about that today and how that affects your investment plan. But it takes an awful lot of time. And I'll just share with you that yesterday I had a call scheduled with a client just to review a life insurance issue, and our senior financial planning associate Emily spent an hour and a half updating a plan just for that phone call. So you can imagine the amount of time it takes to keep these plans updated and build them out year over year, and certainly in the beginning. So thankful for all my staff, thankful for you, and I'm thankful for the opportunity to talk to you today. So let's get going. I wanted to also give you our office hours for this week. So it's a short week. We're in the office today. Jess is in the office yesterday and today, and we'll all be working from home tomorrow. So if you have a need to come in and drop something off, pick something up, please make arrangements to do that today, Tuesday, and the office will be closed Thursday and Friday for Thanksgiving. And then looking forward into December for the Christmas holiday, since Christmas Day falls on the 25th of December, the office will be completely closed during that entire week. So from the 25th all the way through January 1st, the office will be closed. Now, our office manager, Jessica, does check in periodically on our email, but don't rely on that. So if you need a distribution, if you need some funds, if you need something from us prior to that, try to help us out by doing a little bit of planning. But of course, we're here for you in the case of an emergency, and all clients have my mobile number if needed. But we will not, the office will be closed for that Christmas holiday time from December 25th through January 1st. Okay. We're going to look at headlines because I found this interesting, especially after the rally, market rally of last week. That really was on the heels of the consumer price index information, and the consumer price index equals inflation. Oh, and let me just say, if this is the first time joining us, and if you haven't already, hit the subscribe, like, and notification button on your on the YouTube platform, and that way you make sure that you're always going to get our latest videos and notifications for our live videos, because I do this every live on most Tuesday mornings. So we're going to go talk about some headlines, and we're going to talk about, we're going to go over some information I got from the Slott group in our Slott report, and then we're going to talk about the markets a bit, and we're going to then talk about our Financial 15 segment, which is our financial planning segment. And today is age-based investing, and this comes from conversations that I have all the time with prospective clients or clients. And I was talking to a fellow last week, and he said, there are two things we hear often. Well, let's say three. Folks come to us for tax-efficient planning, of course. But when they come in, they say, I don't have a plan. I've been investing for many, many years, and I feel like I've been doing a good job myself, or my financial advisor, broker has been doing a good job, but I feel like I just don't have it all together. I don't have a plan. So that's more common than I can tell you. It's probably 90% of the people, if I had to guess, come in and they say something like that. And then another thing is, how should I be invested? I'm 60 years old. Am I too aggressive? Am I too conservative? How should I be invested? And that's really, really common, because there's a lot of these rules of thumb and myths and misconceptions out there, misinformation, really misconceptions, not so much misinformation, but it can be challenging to figure it out. So I'm going to talk about that during our Financial 15 segment, our financial planning segment, and we're going to talk about how to figure that out and what I think makes the most sense. All right, so let's jump in the headlines. So yesterday we got the leading indicators index, and the headline from U.S. News reads, and they all said the same thing essentially, but I just picked U.S. News. Leading indicators continue to signal a recession. A gauge of future economic activity declined in October after falling in September on worsening consumer expectations, the Conference Board reported on Monday. The business organization's leading economic index fell 0.8% to 103.9, slightly worse than expected. On a 6-month basis, the index is down 3.3%, an improvement over the 4.4% decline in the prior 6-month period. This quote is, the U.S. LEI trajectory remained negative, and its 6 and 12-month growth rates also held in negative territory in October, said Ms. LaMonica, I can't really pronounce her first name, Senior Manager, Business Cycle Indicators at the Board. Senior Manager, Business Cycle Indicators at the Board. After a pause in September, she continues to say, the LEI resumed signaling recession in the near term. So I've been hearing a lot. Let me just pause on that article for a second, but I've been hearing a lot from people out there. Well, I feel like there could be a soft landing, in fact, and the recession seems to be further away or less likely as we move. And we don't know, of course. We're way overdue for a recession. It is a cyclical issue that we see, every 5 years or so. So, and you've heard me say that, if we're being honest, we've basically been just avoiding that recession because of all the funds that were pushed out from the federal government during the pandemic. So they go on to say the Conference Board expects elevated inflation, higher interest rates, and contracting consumer spending due to depleting pandemic savings and mandatory student loan repayments to tip the U.S. economy into a very short recession. We forecast that real GDP will expand by just 0.8% in 2024. So that was an interesting headline from yesterday, I thought, and it was something that we were paying attention to, as far as that's a indicator that the Fed certainly looks at for their decisions on their rate increases, and everybody's paying attention to that. So I'm going to share my screen here with you because I'm going to read the Slott report mailbag. And this talks about the NUA and Roth IRA contributions. And this is written by our friend Andy Ives. And NUA is net unrealized appreciation. If you don't know what net unrealized appreciation is, I'm going to write this down so I know to add it in our description, our YouTube description. Just give me a second. Let me write this down. So I'll put a link in the videos. Net unrealized appreciation. I think it was Andy and I did a video about net unrealized appreciation. And net unrealized appreciation is something that allows you, if you have company stock in your retirement plan, you can transfer that company stock into a non-IRA account. You pay tax on the original cost of the stock. You pay ordinary income tax on the original cost of the stock, but you pay capital gains tax on any growth, as long as you do it right. And capital gains tax can be a preferred tax over ordinary income tax, but that's very different for everybody. Of course, there are plenty of times I look at NUA opportunities, and sometimes they make sense, and sometimes they don't make sense. So it has to be evaluated. But there's a good question here about NUA, because it can be a really great tax saving tool if done properly and if it makes sense for you. The question is, my client's husband recently passed away. We have converted her late husband's 401k to a beneficiary 401k in preparation for transferring it to a beneficiary or inherited IRA. There is company stock inside the 401k currently. We want to leverage the NUA, net unrealized appreciation tax strategy. Is stock inside a beneficiary 401k eligible for NUA, the same as the stock would have been when the husband was alive? And this is from Charles. And as I commented on before, my guess is Charles may have paused and said, well, wait a minute, did I do something wrong in transferring this beneficiary 401k? And maybe I'm missing the NUA opportunity when that happens. So the answer is yes, you can use the NUA tax strategy for company stock and a beneficiary 401k. Death is one of the triggers that opens the NUA opportunity. All or a portion of the company stock will be transferred in kind to a non-qualified brokerage account. The remaining assets can be directly rolled over to the inherited IRA. Just be sure, he writes, the entire beneficiary 401k is emptied in 1 calendar year. Otherwise, the NUA strategy of paying long-term capital gains on the appreciation of the company's stock will be lost. So good response there, Andy, of course, because he knows what he's talking about. So the next question here. I am married and make too much money to... Oh, boy, I thought this was really interesting because it's something we don't talk about often. I am married and make too much money to contribute to a Roth IRA. My wife works and is below the income limits for the Roth IRA. We file our taxes separately. Can she contribute to a Roth IRA, and are there restrictions as to how much she can contribute? We live together all the time. That's Tom. So Tom and his wife file married filing separately. The answer is the Roth IRA contribution phase-out limit for married filing separate tax filers is only $10,000. So you might know from downloading the green tax sheet what the phase-out limits are for married filing joint and single filers, but married filing separate is much different. If your wife has compensation of less than $10,000, she can contribute up to her total modified adjusted gross income level, but not more than $6,500 for 2023, plus an additional $1,000 if she is age 50 or older. So I thought that was an interesting piece of information there regarding married filing separately compared to married filing joint or single filers. Yes. Okay. Now let's go with back to just me, and we'll talk about the markets. So we talked last week about inflation. It came in Tuesday morning, right before our webinar, and we talked a bit about it, but I'm going to repeat it. So headline inflation was flat month over month and fell 3.2% year over year, below expectations of 3.3%, so just a notch below. At the core level, excluding energy and food, inflation rose 0.2% month over month and 4% year over year, which was the lowest level of core inflation in 2 years. So good to see, but we're still increasing, right? And don't forget, we're back. We had just about 9%. I think it hit a little 8.7 or 9% last year. So their take on it is the inflation is moving in the right direction to keep the Fed on hold, although remaining far above the 2% target level. The Fed is likely to be content to wait and see, but continues to note that it won't hesitate to hike again if the cooling of inflation stalls. So they're ready. They're teed up and ready to go if we start see an increase in inflation again. Retail sales fell 0.1% in October, month over month, the first decline in sales since March, and down from the 0.9% gain seen in September. Excluding autos and gas, Sales increased 0.1% month over month, down from 0.6 seen in the month prior. So again, taking out autos and gas, we had an increase. Our report doesn't make a trend. One report doesn't make a trend, but combining the report with recent commentary from retailers shows clear signs that the consumer is slowing. Again, like was reported before, just people running out of that pandemic savings. They're a little bit concerned about maybe what's happening in the economy and around the world. So they're starting to pull back a little bit. We've been expecting a consumer slowdown, and now investors will be watching the degree to which Americans pull back on spending. We're talking about industrial production. So yeah, I'll read this. The reading of manufacturing activity fell 0.6% month over month after a 0.3% rise in September and below the drop of 0.4% expected. Another soft manufacturing report is reinforcing the thought that after rebounding in the middle of the year, manufacturing activity may be feeling more of the impact from the Fed rate hikes. So things are, a lot of manufacturing, they borrow funds to do what they need to do to manufacture their goods. So if the cost of borrowing those funds increases, then of course they're going to slow down. So this week ahead, we talked about the leading indicators. Today, the Fed minutes come out. Tomorrow, Wednesday, is durable good orders, and it's going to be a slow week after that. The overall market recap from this group, the softer than expected CPI report was the major market driver this week, talking about the week ending, the 17th. Then sharp gains seen in November, and the 10-year yield, that's the U.S. Treasury yield that matures in 10 years, continuing its downward trend, moving below 4.5. The knee-jerk reaction may prove to be a bit of an overreaction, but inflation has eased, and the Fed appears to be done with the hiking phase of this cycle. Absent an unexpectedly sharp economic slowdown or some sort of financial crisis, investors' pricing in of interest rate cuts seems overly optimistic, but talks of the hope for soft landing have increased, and the bulls remain in charge. So I'm not sure if I agree that the Fed has stopped the hiking. They've certainly paused, but I'm just not sure if I agree that they've stopped. I think, like I said, they're geared up and ready to go. So let's talk about the numbers, what the market numbers were last week. And I need my glasses for this. So if you're just listening, I'm looking at a report. I'm not sharing it with you, but sometimes I do. So I'm looking at a report, a snapshot I get from a company called Invesco. I don't currently invest with Invesco, and let me just say, when I mention names, and in our Financial 15, I'm going to be talking about Vanguard. I do have some investments with Vanguard currently, but it's not a recommendation to buy, sell, or hold a fund or a particular strategy. It's just used as an example. So our friends from Invesco send out a really nice consolidated report most weeks, but the Dow Jones Industrial Average increased 2.06 last week, It's now up 7.46 year to date and 6.43 over a 1 year period. The S&P 500 increased 2.31%. It's up 19.28% for the year. And the NASDAQ increased 2.43%, up 35.99%. So you got to remember that most of these returns, certainly in the S&P 500 and NASDAQ, are driven by mostly 7 stocks, and that is not uncommon. So, we've talked about the FANGs before. Now it's the Magnificent Seven. There's always these key companies that are driving these index returns. So be mindful of that when you're evaluating your portfolios and comparing them to the returns. Really across the board. So the international indices were all up as well. Even bonds were up. The U.S. aggregate bond index was up 1.37%. The U.S. aggregate 1 to 3 year bond index was up 0.42%. So bonds, the U.S. aggregate index, and as you always hear me say, that's where most investors hold their bond holdings. I don't know if I can say that anymore because so many people have been buying bonds on the short term. That maybe that's sliding down to the 1 to 3 year number, but the 7 to 9 year maturity period in where the U.S. aggregate bond index likely lies has just pass positive territory for the year, 0.54% for the year. And very short-term bonds are up 2.9%. So all good news last week, mostly across the board, and no need to belabor that anymore. So I thought this was interesting. We're gonna read a couple key points from BlackRock, two of the largest investment managers in the world, BlackRock and Goldman Sachs. So BlackRock writes, volatility, a key feature of the new regime. So BlackRock's been talking about this new regime for, I don't know, probably since the beginning of the year. And I talked about it previously, what that new regime is. But they say that we see volatility as a constant in the new regime. We're neutral long-term U.S. Treasuries because risks are more balanced after 3 years of rising yields. Stocks and bonds rallied last week, they said, on milder than expected U.S. inflation data. We see the U.S. economy on a weak growth path with policy rates staying high. And then they said the week ahead, global data this week will likely confirm that higher interest rates are causing business activity to stagnate. We don't expect rate cuts this year. So that's interesting. So they're saying they're expecting perhaps, well, certainly weak growth. So I would assume that means weak growth, weak economic growth. Typically that means weak market growth. So listen to Goldman Sachs chart of the week. So they wrote, we expect stronger global growth in 2024 on cooling inflation, the potential end of the monetary tightening, and a rebound in manufacturing. High cash yields have been a staple of 2023, but we believe that 2024 will signal a resurgence of the balanced portfolio as equities, fixed income, and alternatives may help hedge inflation and growth risks. Still, optimism around soft landing may be reflected in some markets, and investing is paramount in our view. So interesting, because my feeling when I read BlackRock is, okay, we're looking at weak economic growth, policy rates staying high, and then you switch over to Goldman Sachs, rebound in manufacturing, stronger global growth in 2024. So you've got these huge organizations, well-respected and very, very good money managers, Goldman Sachs and BlackRock, saying two very, very different things. So how do you manage that? Well, my approach, asset allocation, principal protection, and account segmentation, and it's a really good segue to what we're going to talk about in a moment. But I'm going to I did like this piece from Empower, and, it's a multi-page piece, but I pulled out the thankful list. So this person who always writes very tongue-in-cheek and quite enjoyable. He writes, here's a list, some of which probably also contributed to last week's surprising rally of what he's thankful for. He said, I'm thankful that Wednesday's producer price index release was also better than expected, and that businesses who responded to last week's business inflation expectations survey by the Atlanta Fed didn't seem to be as worried about inflation as consumers who answer the U of M's survey are. So he also writes, I'm thankful that the UAW strike against the big three automakers is over, removing one reason that last week's industrial production and capacity utilization figures were so depressed. That's good. I'm thankful that massive retailer Walmart was brave enough to call it like they see it and admit that sales trends have decelerated in recent weeks, even as the discount chain continues to take wallet share from other retailers. A little further up on the bouginess scale, and as retail sales across the economy continued to beat expectation. So for those of you who don't know what bougie is, I just learned what it was last year. So it's more high end kind of things, and I guess a little further up would be a Target or something like that than Walmart. I'm thankful that the jobs market is perhaps finally starting to soften, as evidenced by a notable upturn in last week's weekly and continuing jobless claims data, which are still very low by historical standards, but are finally showing signs of going higher. I'm thankful that cooler heads prevailed in Congress, with both a shutdown averting deal and a narrowly avoided fistfight during an official Senate proceedings emerging as examples that at least some small shred of decorum and a spirit of reconciliation, oh, that's a horrible word, spirit of reconciliation still exist in the halls of our government. But most of all, I'm thankful for the so-called seasonals, a fancy word for the uncanny tendency of stock markets to rally in November, which might have gone further in helping to explain why Tuesday's CPI release appeared so intoxicating to markets than anything of a more fundamental nature. So I always find, as I say, I find this person's words funny and interesting. But there's a list of economic things that this person's thankful for. Okay. Now we're going to get into our financial 15. So let me just get my whiteboard together. And here we are. So this week's financial 15, our financial planning segment, is age-based investing. And I shared with you at the beginning of the webinar, and if you're just joining us for this portion of the webinar, the financial 15 portion of the webinar, what you just missed was about a half an hour of market commentary, some analyst reports, a review of what happened in the markets last week, and some information from the Ed Slott Group. The Ed Slott Group is a well-recognized expert group in the area of IRA distribution planning and assistance, and I'm fortunate enough to be part of Ed's Master Lead Advisor Group. We're about 400 plus strong throughout the country, but not enough, folks. And I explained to you, and again, if you're just joining us for this Financial 15 segment, please hit the like, subscribe, and notification button, and so you won't miss any upcoming videos. But as I shared with you in the beginning, just like many of my topics, this came from a conversation with a potential client. So this fellow said to me, I just don't know. I don't know if I'm invested the right way. And what's common we hear is, I don't have a plan. I need help with a plan. And I don't know if I'm invested the right way. Am I too conservative? Am I too aggressive? How should it be split up? So let's start with age-based investing. What is age-based investing? Because it's different than life cycle investing. So age-based investing is, I'm 55 years old. I want to retire in 15 years. So I go out and I say, okay, what if I want to retire? Well, let's not use that age because that doesn't work with my. If I want to retire in 2035, I can go out and I can buy a fund that has a target date of 2035. That's one method of age-based investing. It's choosing your investment allocation based on your age. Now, there's some problems with that. There's some rules of thumb that you'll hear out there. And the first one is the 100 rule of thumb. And they say subtract your age from 100, and that's the type of allocation you should have in your stock and bond portfolio. So if you're 60 years old, you would subtract 60, and they're telling you that you should have a 60% bond portfolio and a 40% stock portfolio. So that may be well and good. And obviously, if you're 70, it should be 70-30 bonds to stocks. That might be well and good for what you need, but it's really a very unscientific way of figuring out what's best for you. And it also leads itself to a lot of issues. How often do you adjust that? Do you adjust it by decade? Do you adjust it every 5 years? Because it shouldn't really be static if it's age-based portfolio, right? Do you go every year and change it? Now it's a 61-39 and a 62-38. How often should you review that? So that's not something that's really discussed in the theory. Overall, they talk about adjusting it over time, but really at what intervals? It would probably make sense just from a logical point of view to adjust it every 5 years. But you have to take into account other things that might affect the portfolio. So the first thing is, what's your acceptance for risk? Forget about the age and some simple, I almost said silly, but I'll just say simple rule of thumb. And the issue with these rules of thumb, it's like the 4% rule. We talk about this. You hear about the 4% rule. If you don't withdraw more than 4% of your portfolio, then you're likely not to that run out of money during your lifetime. Accept. And I don't I don't follow that rule, and I don't suggest that you follow that rule. And I have a whole video about the 4% rule too. And here I go with my notes. I'm going to link my video about the 4% rule. But I have a whole video about the 4% rule. But I hear the 4% rule all the time, and you shouldn't follow the 4% rule. There's a lot going on social media right now about Dave Ramsey, who maybe you may have heard of, but I'm sorry here, I'm covering up my 4%. But Dave Ramsey is really a personality on on the radio and now on YouTube, and I'm just going to be honest with you. He gives kind of wacky financial advice sometimes, and he's talking about an 8% withdrawal rate and a 10% withdrawal rate, or a 10% earning rate and an 8% withdrawal rate, which can be really dangerous for people. And I really don't know where he's coming from with that, but 4% may be too high for you. It's all very, very individualized. So the danger of these rules of thumb, whether it's using the rule of 100, and I have 120 here because there's now a thought that people say, well, with longevity, maybe this should be the rule of 120. So subtract your age by your age by 120, and that's how you get your mix of stocks versus bonds. Well, that may not make sense either, depending on your situation, depending on your risk tolerance, and depending on your needs. And we're going to talk about that in a minute. But the reason that these rules of thumb are dangerous is because they really do a good job of sticking in your mind. And because this is what I hear, investor behavior is just so important. And that's why I opened up this conversation with it's so important. And I love the opportunity. I'm thankful for that opportunity to talk to you folks all the time on a weekly basis, or whenever you can check in, listen to the recordings, because these rules of thumb, these 4% rules and other kind of things that have been thrown out there, they stick in your mind, and they're easy. Well, geez, if I just subtract my age by 100 or 120, if you think you're going to have longer longevity, then I can choose a portfolio, and that'll be fine for me, and then adjust it periodically, hopefully, if you remember to adjust it periodically. Or you can choose a life cycle fund where you identify your risk tolerance. So, that's another thing. Scale 1 to 10 is often the risk scale, and people say, where do you fall on here? 1 being the most conservative, 10 being the most aggressive. Where do you fall on here? And if you fall in the middle, and let's say the middle is 50-50, well, geez, you could just choose a life cycle fund, and there's other names for it, but a kind of a risk appetite fund, commonly called life cycle fund, and that's where I feel comfortable. So that must be good for me. That's not necessarily the answer either. These are easier things, but you want to avoid these rules of thumb, and even something that is more dynamic than or more dynamic something that I'm going to use an example of a Vanguard fund. And again, I have nothing against Vanguard. I use them in our own portfolios. They're they can be very efficient. And that is not an offer or a suggestion to buy, sell, or hold a Vanguard fund at all. But I'm going to use this as an example, and you'll see some of the issues with it. So you've got to work through what is correct for you. And the danger is they're very popular in 401ks, 529 plans, etc. They're very easy to access on the internet, very easy to do on your own. A lot of financial advisors lean on this information. Well, hey, that sounds good to me. And people agree. People say, oh, yeah, I've heard that. You subtract your age by 100, and that's how we develop your portfolio, where I take this test, this risk analysis test, and I fall on here somewhere is my point, and a portfolio is developed off of that, and that is then maintained. Well, that doesn't always work either. And there's a lot of issues with that. So we've got to talk about these issues, and we got to talk about potential solutions. So now let's talk about the issues. All right, so now I'm going to slide over here, and I put together some things from the Vanguard website. And again, I really like Vanguard. That is not an offer. or suggested to buy, sell, or hold, or use Vanguard. This is an example, but they're a really good company, and I wanted to use them as an example. So let me read this product summary to you for this fund. This is the Vanguard 2035 fund. So I thought this was a good start because, if you're 60, that might be your time, or 58, or maybe even 70, who knows? That's the whole other part of it too when you're talking about age-based funds. Listen, folks, they're going to drag me out of here at retirement, right? I am certainly, earliest I plan on retiring is age 70. So why in the world would I want to invest based on my age at that point when or at age 65, based on my age, when I may have 5 more years of retirement and I might be too conservative at age 65. So I hope that makes sense what I'm saying to you. But there's other built-in potential issues. So let me read this to you. So the product summary for Vanguard. The Vanguard Target Retirement Funds offer a diversified portfolio within a single fund. That's nice and easy, right? That adjusts its underlying asset mix over time. Hey, good. It's dynamic. It changes over time. The funds provide broad diversification while incrementally decreasing exposure to stocks and decreasing exposure to stocks and increasing exposure to bonds as each fund's target retirement date approaches. The funds continue to adjust for approximately 7 years after that date until their allocations match that of the target retirement income fund. We want to get to the target retirement income fund, Vanguard says, because that's where you're going to be drawing from those funds. Investors in the funds should be able to tolerate the risks that come from the volatility of the stock and the bond markets. You may wish to consider this fund if you're planning to retire between 2033 and 2037. I can't tell you how many people invest this way. They invest this way because it sounds good, because it sounds dynamic, it makes sense, and it's easy. You can just choose one fund, and this is all going to be done for you. So let's look at the makeup. So this is a 70, I wrote it here, 70% stock, 30% bond fund. Yes, that's right. And you'll see it consists of 4 Vanguard funds. The Vanguard, I'll make this a little larger so you can see. The Vanguard Total Stock Market Index Fund, Institutional Plus Shares. Vanguard Total International Stock Index Fund, Investor Shares. Vanguard Total Bond Market 2 Index Fund. And the Vanguard Total International Bond 2 Index Fund. Again, I don't know whether these are good funds or bad funds. I haven't looked at it, but that's the makeup of this fund. So it's what we call a fund of funds. Now, what they say is, and let's look at the risk. So over here, remember, they're using a 5-point scale risk. And this less risk over here on the left, more risk over here. And this is where this fits in. So more on the higher side. If you're listening just on, if you're listening on YouTube and you're not looking at the video, what I'm showing is a 4-point scale. And this would be from 1 to 5. And this fund falls at number 4. So more of a risky, right? 70% stock, 30% bonds, more on the risky side. And then what they want us to get to is this target retirement income fund. So you can see that's made up of the Vanguard Total Bond Market 2 Index Fund. I'll make that a little larger again so you can see the funds. The Vanguard Total Stock Market Index Fund, Institutional Plus Shares. And by the way, I'm not sharing with you any inside information. This is on the Vanguard website. So I just Googled these funds this morning, and so you can look this up anyway, but I'm sharing with you what's on here. Second, the Vanguard Total Stock Market Index Fund, Institutional Plus Shares, and the Vanguard Short-Term Inflation Protected Securities Index Fund, Admiral Shares, Vanguard Total International Bond 2 Index Fund, and the Vanguard Total International Stock Index Fund, Investor Shares. So there is some stock, but it's 30% stock, 70% bonds. So that's their target retirement income. And remember, that's the target that they're getting to over time so that you continue, theoretically, so that you continue to have growth, but you've got some stability on the bond side. So let's read the product summary for this one. The Target Retirement Income Fund is designed for investors already in retirement. The fund seeks to provide current income and some capital appreciation by investing in Vanguard index funds. This fund's allocations to stocks and bonds is the allocation that all target retirement funds are expected to assume within 7 years after their designated retirement dates. Investors in this fund should be willing to accept modest movement in share price and I'm going to highlight that, modest movement in share price, and be able to tolerate the market risk that comes from the volatility of the stock and bond markets. So that all sounds good, right? So we pick that 2035 fund. It dynamically moves, and that's kind of a more active age-based marketing. Age-based investing. It's going to do it for us, right? It's going to move it over time, and within 7 years of that target date, it's going to end up in the Target Retirement Income Fund. It'll be more aggressive until it lands in the Target Retirement Income Fund. Well, this was a great illustration, and I didn't know what this was going to look like, but let me share this with you. So going back to this top fund here, the 2035 fund, which is 70% stocks, 30% bonds. What was the return for 2022? So 2022 was a tough year for a lot of people. Let's see what the return was in 2022. Well, in 2022, the return of the 2035 fund, that's what this is, was negative 16.62%. So if you have $1 million in an IRA in this fund, you're down $160,000. $160,620, I think it would be, right? So let's just call it $160,000. Now, what if you're in retirement and you've got to take out $100,000 to spend that year? Well, you never get the time for that $100,000 that you've now taken out and spent to recover. So that is a permanent loss. So you're digging out of a 16% hole. All right, now you might say, but Mark, this is years away, and we're going to get to the total income retirement fund. And that's where it's more stable, and that's where we're drawing that income from. So maybe you're not being genuine about that. All right, let's look at the return in 2022 of the total income retirement fund that has less risk on the 5-point risk scale. Total retirement income fund, has less risk. It's a risk 2 on the risk scale. And the total return for 2022 was negative 19%. So it lost more than the more air quotes, quote unquote, aggressive 2035 fund. Why is that? Because of the allocation of bonds, and bonds got clobbered last year. So that same $1 million IRA was down about $195,000. So that's worse than $160,000. That's my official CFP opinion. That being down $195,000 is worse than being down $165,000. $160,000. I know I'm being silly there, but this just goes to show you that you've got to be careful what you're doing, because the more conservative, again, air quotes, quote unquote, fund was actually lost more money. Now it's up. I put this here because it's up so far this year. I think as of the 20th of November, yesterday, close of business yesterday, 6.15%. So that might sound good. Well, geez, year to date, it's up 6.15%. You're not even close to, if this was the beginning of 2022, and this is negative 19.53, positive 6% gets you probably not even there, more like here, digging out of this hole. You can still see the bottom of that hole. Hi, Leighton. You can still see the bottom of that hole. You could probably drop down and almost touch it, and so you're not even close to digging out of this hole. And if you had to spend $100,000 out of this portfolio and you're down 19.53%, does that 100,000 ever get a chance to recover? Of course not. The answer is no. So that is an issue with kind of taking the easy road, right? It's like saying, okay, well, I heard this rule of thumb. Just subtract my age from 100 or 120 if I'm being current. And that's how I should be allocated and adjust it periodically. And listen, let's be honest. If you, if you're working with a financial planner, if you're working with a financial advisor or a stockbroker, they should be adjusting that portfolio on a regular basis. But it's likely, even working with a traditional financial advisor, that portfolio is going to stay static. That means it's going to stay the same until there's some kind of outward reason to change it, or unless you request a change. Just because we've seen it. I'm fortunate, folks. I have the opportunity to coach financial advisors all around the country. I was just asked to speak at the Power Zero conference in January in Scottsdale, Arizona. I'm really excited about that and looking forward to that. There'll be 100 or so like-minded, Power Zero-minded individuals, financial advisors in the country, and I have the opportunity to give them my thoughts on things, and I appreciate that. But most portfolios, advisor-driven portfolios or individual portfolios, aren't dynamic that way. They don't adjust on their own. Even something as good sounding and potentially working as this Vanguard structure. You go to the 2035 fund, and it morphs over time to the retirement income fund, target retirement income fund, the Vanguard target retirement income fund. That all sounds great, but it could really whiplash you in retirement, down 19.53% in 2022, something you may not ever be able to recover from, or could have a significant impact on your retirement. And this is one of those critical items that can have a significant impact on your retirement. And, if you knew differently before, you may have made different decisions. But now you know. Now you know, and you can act on these things because I've given you this opportunity through education. So pay attention to these things. Even though the rating is lower, it's 2 on the scale as opposed to 5, the risk scale. Well, it lost just about 3 points, 3% more. And on $1 million, that's $30,000. So that's significant. All right, so how do you address this? Well, folks, the 3 pillars of investing are, say it with me, asset allocation, principal protection, and account segmentation. I think it makes more sense, and I said to this fellow that I was talking to exactly this, so I wrote it down. Where the heck is it? I thought I wrote it down. Oh, yeah. It was, I didn't write down the quote, but this is what I said when he was talking about, well, how should I be invested? I don't know if I'm investing too conservatively. I don't know if I'm investing too aggressively for my age. And I said, risk isn't age-based. It's time-based, and it's needs-based. So the age-based approach doesn't work, in my opinion. Subtract your age from age 100 or 120 and develop your portfolio that way. And the time-based doesn't just work either. Like, not picking on Vanguard, a 2035 fund that eventually morphs into the total retirement income fund or something like it. That doesn't work either. You have to also add in the needs. So age is a consideration in planning, but honestly, it's not really a consideration in investing. The plan drives the investment. The time and the needs identify where that investment allocation should lie. So again, it's not age-based, it's time and needs-based. So look at this here on my screen, and this is the account segmentation I talk about. I'm trying to fit it all on the screen. So you'll see here, and I know these are a little small, but let me blow up one. Use an example. Segment 1. Now, if your clients of ours, you've heard this. S1 referred to as segment 1. Our segment 1 portfolio, you can see, is bonds and money market. We're getting about 5% in this portfolio with 0 risk. And we call it segment 1 because we know that this is to be used during the first roughly 3 years of retirement. So if you're retired in 2023, this would take you to 2023, 2024, 2025, 2026. The importance of that is for the money that you're going to spend now or in the next several years, you want 0 to little risk. Not negative 16%, certainly not negative 19%. Because I use the example of $100,000. If if you're in a segmented approach and you need $100,000 and the market's down 19%, is the $100,000 you take out of this first segment going to affect you? No. The answer is no. My 100,000 is here. Sorry, I was blacking it with my picture. The answer is no. And if I needed $100,000 in each one of these segments, then we're covered for the next 3 years. We don't have to worry about market fluctuation or market volatility. It makes sense. And by the way, it works. So how do we get to how do we figure out this number and how much goes in here? You know, if we start with 300,000, and it would actually have to be less than that because we get growth in here. And right now we're getting 5%. Now I rate 5% on there. Our target is 2%. Our target is 2%. We're getting 5% now because we're living in this odd world where short-term interest rates are giving us more return than higher interest rates. And we're going to go a little over, probably past 11 o'clock, just a few minutes, but I'm going to break it down in the different segments or chapters on our recording, but stay with me if you can. Normally this is 2 to 3% in this segment 1, but right now we're getting 5%. So we don't have to quite put $300,000 in there to get $300,000 over 3 years, do we? No. But how do we come up with a $300,000 number? This comes from the financial plan. The investment decisions are driven by your needs. Your needs are identified from your financial plan. It's really that simple. It's not easy, but it is simple. Most people come to us and say, I don't have this. I don't have this financial plan. Therefore, they don't know how they should be investing. They lean on things they've heard, the 4% rule. They lean on my age. How should I be invested on my age? Or they look up something and they say, well, if I just subtract my age from 100 or 120. When in fact, what they should be doing is identify these needs in each one of these segments of time in their life. Because the idea is to get you, I went out too far, to get you to where you're no longer here. You've lived your full life, a happy retirement. You're no longer here. Hopefully you still have some money left in our what we call our legacy longevity portfolio. And if I blew out each one of these portfolios, what you'd see is it gets more aggressive as we go out. So the green, if you just take a look at it, the green in these portfolios is stock holdings. So segment 2 is 40% stock, 60% bonds. Segment 3 is 60% stock, 40% bonds. Segment 5 is 80% stock, 20% bonds. Segment 4 is 80% stock, 20% bonds. Segment 5 is 90% stock, 10% bonds. And this all green is what we call our legacy longevity. And that is money you're likely not to need during your lifetime. But if you do, it's available to you. But if you do need it, or if you don't need it, you pass it on to your heirs, whomever you'd like it to be. But you have to identify the dollar amounts that go into each one of these segments. How much do I need during each one of these times and invest it accordingly? And then it doesn't stop there, folks. These portfolios, usually not this one, but these portfolios all have to cascade down as you use them. And it has to be very dynamic. Sometimes money comes back. Sometimes if we're overfunded here, we might move it down to legacy longevity or even, back into this segment here, but it has to move back and forth. So remember, you've got to identify your dollar needs from financial planning. And that drives how you should be invested and where on that timeline. This is your timeline, right? The line on the bottom, where it fits on your timeline for which segment of your life. That makes the most sense. So forget about age-based investment. Focus on needs-based investing. And of course, there's time in that too. But once you identify your needs clearly in your financial plan, and when you're going, so needs is how much you're going to need and when you're going to need it. And that's the things that you need to do and the things that you want to do. So how much you need, when you're going to need it, the things you want to do, things you need to do, and then you plug in the investments around that. There's a lot of other work that goes into developing the portfolios and monitor the portfolios to make sure that they're the very best that we can be, or they can be. But that makes all the difference in the world. So I think that makes sense. I wrote here, everyone has a different start date. Everyone has different needs. Everyone's got a different financial plan. I think the segmentation and needs-based investing makes a lot more sense than some rule of thumb that somebody made up. Have it be very specialized and specific to you, and that works. And we are within the 11 o'clock. So, folks, I hope that was helpful. If you have questions, you can reach us at questions@attleborowealth.com. That's here, questions@attleborowealth.com. If you want to schedule time with me, if you're not already a client and you want to schedule time with me, you can do so by reaching out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. If you're a client and you need to reach us, pick up the phone or send us an email directly, and we'll get you on the calendar as soon as possible. It is the end of the year, folks. And I've said before that, everybody knows that accountants and tax preparers are terribly busy from, they call it January, but probably February until tax filing deadline. And everybody understands that. Well, folks, this is that time for us. We are extremely busy in our office and really thankful and happy to be able to be this busy and to be able to do this great work for people and save people just bundles of money over their lifetime by doing tax efficient planning. But be mindful that if it may be a little while before we can get you in the calendar. We do the best we can to squeeze people in. Monday, I'll give you an example. Monday's usually a day that I save for not having appointments, just to be able to prep for the week and catch up on things and do the work that we need to do. And I had 3 appointments yesterday, at least 3, maybe 4. So I'm not complaining. I'm thankful for that. And this is a week of thanks. And I'm thankful for all of our clients, all you folks who are not clients or not yet clients who are listening to this. But I am thankful for you keeping your mind open to things that are maybe different than what you've heard before. I hope it makes sense for you. I hope you implement these strategies and they can make a difference in your retirement plan, because remember, these critical items can have such a huge impact in your retirement plan. And myths and misconceptions, things that you've heard in the past, maybe drove your decisions in the past, that you realize now, if you would have done things differently, you'd be in a different place. But it's not too late to do that. So make these changes in your portfolio potentially if it makes sense for you. Reach out to us with questions you may have. Work towards a tax-efficient strategy. If you have questions about that, we can talk. But I hope you have a great Thanksgiving. I hope you have a great week, and we'll see you next week. If you have any input or questions, things you'd like to hear via webinar, reach out to me, again, at questions@attleborowealth.com. And you can visit our website at attleborowealth.com and download a whole bunch of good stuff, tax forms, other videos, and feel free to share these videos with your friends and family. All right, folks, take care. Have a great week. Happy Thanksgiving.